Good afternoon and welcome to BizTech's Asian Midday Market Watch, powered by the Private Pension Administrator of Malaysia, PPA, which is the central administrator for private retirement schemes. It's the 14th of April, and we have Gabriel Yap, Executive Chairman of GCP Global, as our guest today. Gabriel is a REIT specialist and is a top 20 investor in many REITs on the SGX. Now, Gabriel, as always, welcome to the show.
Thanks for having me, Brian.
Now, Gabriel, before we move on to REITs, let's take a look in terms of markets. Now, markets were up overnight sharply on Wall Street. What's fueling the surge?
Well, I think the market initially had got it wrong the previous 2 days. The previous 2 days you saw the CPI numbers came in below expectations. The growth in core CPI was at 5.6%, the lowest by far, since the peak that we saw 6 months ago. And then yesterday, to compound to that, you have the PPI numbers, both the core as well as the actual numbers, showing that a few things that are very much in vogue. One is that the cooling off the economy, which have started 6 months ago, has continued in abeyance. Two is that the recession fears have now seemingly replaced the inflationary fears, probably have been overrated. Now, thirdly, if you study the minutes of the Fed meeting, which was released after the market closed on Thursday, it did say that essentially the projection, for a mild recession going into the second half of this year and coming out in 2024 has been projected. But mind you, for your viewers, Brian, a projection by the Federal Reserve staff, is not a base case scenario of the Fed. Now you understand that the staff that work the numbers are actually staff. They are not the policymakers, which are the federal governors. So I think one should be watching out for exactly what the federal governors guide, as opposed to actually what the staff of the Federal Reserve. And that's why I think the market got it wrong 2 days ago.
Okay, and that's a very good point, Gabriel, that we really need to segregate those two opinions.
Certainly so. I think in this modern age of social media uh, and popular media, I think it is imperative that a media like yours, actually set forth knowledgeable understanding of markets, knowledgeable understanding of facts, because this is the facts that determine prices, as opposed to actually, hearsay or just reporting of other reports from other medias, which is normally the case.
Now, Gabriel, I want to now shift to our side of the world. How should we be taking all of this in, and how should we be reacting, and where should we be parking our money?
Well, for us at GCP Global, we have already taken the view that the October low that we saw last year was possibly the low. I think it's unlikely, even if the economy moves to a recession conditions, unless it's a severe recession condition. The October lows that we saw, to be exact, was actually October 21st. Be it for the REIT market, the US market, or Singapore, or the Asian markets, have been seen. But in most turnaround situations, you actually have a series of what we call higher lows. And that's what's been played out in the last few corrections that we saw in this year. So you notice that the corrections that we've seen after the huge run up in January, that was actually in February this year, that closing low levels are still above the October lows that of last year, be it the S&P, the Asian markets, or the Singapore REIT index. So I think it is very firmly in trend with what we've been projecting. And this is not surprising, because if you study how the market recovers after each of the major crashes, that the Great Recession crisis, in 2007, 2009, the thereafter, as well as actually the pandemic crisis in 2020, the thereafter, as well as actually the 87th, 19th of October crash, then the thereafter. You can see that the recoveries, you have a series of higher lows amidst intermittent uncertainty, which is very normally the case.
Okay, then, you're a REIT specialist, you're a top 20 investor in a lot of REITs in Singapore. What's your take on the REIT market in the first quarter of this year, which we've just passed?
Right, right. We are still major top 20 shareholders of Fraser Centrepoint Trust, CapitaLand China, CapitaLand Ascendus, we just name a few. Essentially, our prognosis is that the worst for the REIT market has probably been seen in October last year. We reckon that essentially this movement of the 10-year bond yield is indicative of how things will develop in the next coming months. Just a recap, Brian, the 10-year bond yield in the US actually went to as high as 4.2%, and then actually it crashed back to 3.3% with the collapse of the Signature Bank as well as the Silicon Valley Bank just a couple of weeks back. Henceforth, you notice that the recovery in the 10-year bond yield has been very muted. That's up to 3.5 before it pulled back to 3.4% that you saw this week. But more importantly, the inverse gap between the 10-year and the 2-year bond, which was in the region of 80 to 100 basis points, have actually dropped back down to 60 basis points, meaning that while the 2-year minus the 10-year bond is still negative, but that the degree of negativeness, that magnitude has actually narrowed. I think that's very important because it actually is getting close to the turning point as we have seen previously in other recoveries. And I think this is the key point that we're looking for and monitoring on a daily basis to help us guide the end of this basically bear markets.
On that note, Gabriel, thank you very much for your insights. Thanks for coming on the show.
Thanks, Brian.
Now, we've been speaking to Gabriel Yap, Executive Chairman of GCP Global, on BizTech's Asian Midday Market Watch, powered by the Private Pension Administrator of Malaysia, or PPA, which is the central administrator for private retirement schemes. I'm Brian Fernandez. This video will be on our various platforms as well as our website, www.biztech.asia. It will also be on our syndication partners, TV stations, radio stations, and websites. Thanks for tuning in.